Okay, I'm just going to kick the webinar off here. Thank you very much for attending this weekly market analysis webinar from LCG. My name is Jasper Lawler. This should take about 20 minutes, and then in that time we'll cover the sort of. So I assume you've had enough time to read through that risk warning at this stage. Let me put this to full screen mode. Good on the white screen. Hopefully that's working for everyone on the webinar. Right, let's start with the currency markets. We'll default towards the euro here. Euro is still firmly in an uptrend. The theme at the moment with the euro is that economic data is improving. We had some strong PMI data in Europe last week. That was against a backdrop of a slight slowdown in UK PMIs, so not just global growth doing it, but I think that's helping. We had some export data today from Germany that was ahead of expectations. So all that's feeding into the idea that actually the ECB need to stop their QE program, perhaps even earlier than they intended in December. So that's boosting the euro. That's the general backdrop, but obviously we've got data points here and there, both from the euro side and the dollar side, that will affect this trend. For the moment, we've seen 113.50, which we highlighted in last week's webinar. We were just about here last Monday, and it looked like maybe 135.50 was going to give way. We almost got down to the 113 mark, and then eventually it was that kind of 113 to 113.50 mark that basically acted as support. We came up towards the resistance and just gave up a little bit from here. So possible that this correction goes a little bit further, perhaps down to 125 in the 50-day moving average, even just down to 113 proper, which would be about the 20-day moving average at this point. I can see that happening, but overall, at the moment, there's not much evidence for me that you want to be a seller, though we certainly should bear in mind that this is a pretty key level. We're up near the top of the range. Last week was a sort of hanging man type candlestick pattern, as close as you can get in the forex market, with this kind of long lower wick and a short body. So that's just showing indecision, really, not really enough to in itself to justify short the market. You just got to be aware that this is a key level. So to see the market slightly topping out from here is natural, but I wouldn't describe these moves as a real vicious selling coming into the market. To me, the trend looks still to be intact. That may be different once we get up to the 115 mark. You could see some more long-term positions coming into the market at 115 to the short side. That would need to be overcome to see this trend push forward. But for me, still looking for the correction to end within this vicinity above the 112.50 mark, really. I think below there, then we're getting some bigger evidence that the correction's in place. Also look for some sharp moves down, particularly if we pop to the top side and a sharp move down from 115. That's a sign of big sellers coming into the market, and we'd have a bit more work to see the uptrend push higher. Moving swiftly on to the British pound. This is better seen from the weekly chart to start with. We talked extensively about the rebound off the 20 and 50-day moving averages. We had a nice bullish follow through, but pulled back, as you might expect, from the 130 handle again last week, but not even really taking out half the previous week's gains. Not even a dark cloud cover pattern, really. So nothing to get too worried about. Again, to me, I'm still fairly positive on the pound. Fundamentally, why? Well, it seems like the Bank of England are becoming a bit more balanced now. Even if you don't think they're going to hike rates, maybe not even this year, given all of the Brexit uncertainty and the election uncertainty, still it seems very unlikely that they're going to cut rates again soon, or indeed add to QE. You'd imagine actually there's quite a good chance that they actually stop the QE program, or maybe even it seems unlikely they would sell some of the recently bought bonds, but that is a possibility, something you've got to factor in. While the UK economy seems to be slowing a bit, I mentioned those PMIs. have a fair bit of economic data this week, unemployment being one that we highlighted in the week ahead video, a bit of stagflation risk almost at the moment, where inflation and unemployment could start to rise, and obviously inflation data too. So that's, that'll all be key for whether we see a bigger correction down from 130 or whether these daily moving averages, which are congressing around the 128.50 mark, where they act as the support and we can push forward from here. But yeah, 128, these lows through here, plus the moving averages, if I just draw that in, to me, I would expect this zone of support to hold. Can't take much away, so there's a big bearish engulfing on Friday. Sundays we can't take much from, so wouldn't be surprised to see some soft data this week, maybe push us down to 128, and then maybe those longs that, whoever was buying the market down here in this breakout, maybe they start loading up again to send us on this longer term breakout to the top side, maybe towards 133, 134, which were these peaks before we had this last leg down. Dollar yen's a nice trending market at the moment. We highlighted that we thought this was significant support back when we were down here after these two long leg candles came in at the 50% and the 50-week moving average with some nice follow through to the top side. And to me, it looks like this correction has ended, as I've mentioned the last couple of weeks, and I think we're opening up our possibilities for a retest of 118. So at the moment, it's a fairly consistent daily trend. Obviously, we've just got to be a bit savvy to the resistance coming up here from about 114.50ish. That could obviously slow the market down, because obviously we had a similar thing around the bottom. If we are just in a range market now, then obviously we didn't make any gains below this low. Maybe we don't make much gains beyond that high, and we're drifting sideways. That's a possibility, but I think this 50% retracement of this big move is probably the base for now. And even if we pull back a bit, similar to the euro and the pound, I think eventually we push higher. It's the base case scenario. We've just got to look for opportunities to suggest that that's still taking place. A little tricky at the moment because we literally would be buying the top of the market near a resistance. So really want this resistance to be taken out or a bigger correction to be able to step in on this. Euro pound, yes, it's really in this kind of very whippy range. A couple of times I've been expecting it to break to the downside. It hasn't happened yet. At the end of the day, the European data is a lot stronger than the UK data, but still, that being the case, it still seems probably likely that the UK is a lot closer to raising rates than it is in Europe. So, don't know how bullish you can really get. I mean, I think the market default calls on this are for about 90, and we're at 88.50 now. We're only 150 points shy of that. So is there really the conviction to send us that extra 150 pips to the kind of market consensus target around 90? Yeah, it's debatable. We could be putting in a triple top here, 1, 2, 3, roll to the downside, but it's not really very clear where the neckline is, so it's a bit hard to sell really. So the FTSE, I'd say the way trading's panning out today is potentially a negative sign, because we had a positive start. We opened above the highs of the last few days and then rolled over again. To me, I would just suspect that we've got a bit more room to the downside. If you're looking for an opening, well, there was an inside week last week, so if we get a drop through last week's low, then you're getting some confirmation of a breakthrough the inside bar pattern. It wasn't a massive conviction sell-off, but what got me interested was the fact that we had these two rebounds off the 7,400 level, showing a lot of demand, but that was quickly absorbed, and then we broke through it again. So it seemed like the market wanted to rebound and push up to new highs, but there wasn't quite, or maybe the selling just overtook the the buying when we got back up to 7,550 again. So to me, the fact that we took out this level here basically, and we came up and tested it, didn't get through it last week, and now we're rolling away from it again, to me suggests that there's more downside to come in the FTSE. And that would also pan out if indeed the sort of our base case scenario, the pound appreciates further from here. That would obviously play into the weaker FTSE too. Can only get so bearish on a massively bullish stock market, but it seems to me that there's a little bit more room to the downside before we end this dip. Some pretty clear-cut selling in the Germany 30. I don't typically cover the charts of the bond markets, but there has been quite a sell-off in bunds. So German 10-year government bonds have been selling off quite a lot. Yields have been rising, and just because QE from the ECB has been such an important reason why both assets have been rising, they're both kind of falling together for similar reasons. That suspicion that ECB might be about to get a bit more hawkish. So the clear resistance here is the 1250 mark. That was the support before that we gave way. With a bearish engulfing on the Thursday. Friday was an inside day. If today breaks to the top side of the inside day, but then closes inside the day to the negative, that to me would be a fake breakout of an inside day pattern, fake breakout of a harami, and would to me suggest lower prices, and that we take out this base here. Where do we go if we do break it? Well, there's you could put the 200-day moving average on the chart. Not quite sure where that comes in. Let's add it in. I would imagine it's probably quite far away. I try not to confuse things with too many moving averages, but if there isn't a clear-cut support, well, as a point of reference, yeah, it is pretty far away. I think probably more like the 12,000 mark, which coincides with a series of highs here and the base there, would be more like a natural finishing point. We also had a gap here on our charts. I'm not sure if that gap features in some of the other prices out there as well. So just double check that gap is reliable, but the beginning of that gap, if it were to be filled, would be around 12,090. Moving swiftly on to Wall Street. So we had a positive week last week on our charts. I think the spot prices edged out a positive finish too. So still looking quite strong relatively in US stocks. Worth bearing in mind that it's the beginning of earnings season proper this week. So we're getting some of the big banks reporting in the US on Friday. So earnings will start to take precedent again. So it depends whether you think there's a kind of a reduced geopolitical uncertainty, but yields seem to be rising, maybe slightly less central bank support. Obviously, it's the bull market's getting a bit old at this point. The saying is they don't die of old age, but nonetheless, clearly it's been quite a while since the low in 2009 now. So longer term picture, you'd imagine this bull market has to roll over fairly soon, but at the moment earnings have actually begun a bit of a recovery in the US. Minus a few sectors. Amazon's completely crushing the retail sector, but even though the oil price has dipped, the energy market is recovering a bit since we bounced off the lows in oil prices, and tech sector earnings still doing very well as well. So, plenty of reasons still to be quite positive on the market, but obviously a little bit of consolidation taking place at the moment. Not quite as worrying as as what's happening in Europe. So this would be to me the kind of we had the kind of false breakthrough there once. If we got through there again, I'd have a bit more confidence that we could see some more selling. But maybe that still only ends up, you've got the 2100 2100, 100 level there, and then these highs come in just below around the sort of 21060 kind of area. So a confluence of support there could even just be the end of any further extension of the dip, even if we indeed do get one. Now, taking it off the chart now, but we basically hit around the, I don't know if that was quite the 50% level in Brent, certainly was in US crude, but we hit the kind of Fibo levels. I haven't got the, if I add the 50 on, it's around that level. Yeah, it's pretty much hit the 50 plus the 50-day moving average, the 50% retracement, and we put a nice little spinning top at the top. So if you just sold the break of that spinning top, obviously you'd be like quids in at this point, and it seems quite likely that we're going to test the lows again. It was a strong rebound, so dead cat rally potentially, but if we pull out to the longer term charts, we see that actually 45 is quite significant support. So probably a test of the lows, I would imagine a 45 again, but maybe we don't get any heavy renewed selling, especially given it's the summer. It's not necessarily when the biggest trending price action moves happen. But I mentioned this 45 on the RSI on the weekly chart before. You do see that we held it. You know, we broke. There was support. Support broke. Retested the support as resistance. Now heading lower again. So certainly, you know, I wouldn't be an aggressive buyer of this market. But we'll have to see what happens if indeed we get a drop down to 45. You know, should you see some patterns emerge there, you know, potentially we are looking at a base. But to me, the general picture looks quite soft. We're making lower lows and lower highs in the weekly chart. That 45 pivot, we're well below it on the RSI, and you know, the levels that you would expect to be resistance are you know, seeing quite heavy selling down from them. So still looking quite soft, and I think overall commodities quite looking soft. When you look at gold, obviously traded right through the trend line, got a bounce from the previous low, and as of Friday we were right through there. I don't always mention silver, but you see that there was a heavy sell-off in silver. It took us right down to the lowest levels since the start of the year. We've got a heavy bounce from there, but nonetheless, I don't think there's quite cause. Even though we finished off the lows, I think it was just because it was such a strong down day. It was still negative again today. Yeah, these metals markets look a bit soft. We've a fair bit of Chinese data coming out today. It goes some way to explain why we're down again today. The inflation data was a bit weak. Quite a lot of evidence the Chinese economy is slowing, and that maybe the government doesn't want to pump quite as much stimulus into it. And then whenever we say that in the past, they normally do end up doing it. So I think that's about it for the webinar today. Thank you very much for attending, and good luck with trading this week. It's Jasper signing out.